Most people think money is about what they can see. They think money is the price tag on a house, the sticker on a car, the number on a paycheck, the green arrow on a stock chart, the rate quoted by a bank clerk across a polished desk. I have lived long enough to know that the visible number is almost never the real number. The real number sits behind the curtain. It moves first. Everything else adjusts later. And if you do not understand bonds, you do not understand money, you do not understand why one family can suddenly afford a house while another cannot. You do not understand why stocks can look brilliant for a decade and then feel dead while corporate earnings still appear respectable. You do not understand why companies that bragged about expansion in one year are firing people the next. You do not understand why one era feels easy and another feels heavy. You are standing in the middle of the game, but you do not know who is setting the score. The bond market is. That sounds too dry for most people, so they dismiss it. They hear the word bond and imagine old men in gray suits. Safe little coupons, sleepy returns, some dusty corner of finance that matters to pension funds and nobody else. That mistake is expensive. It is expensive because the bond market is not a side room. It is the pressure system for the whole building. It tells you what time itself costs. That is the first thing I want you to hold on to. A bond is not really a piece of paper. A bond is a price on trust, a price on time, and a price on survival. When a government issues a bond, it is making a very old promise. Give me your money. Now I will give it back later, and I will pay you for waiting. The principal is the money you hand over. The coupon is what you earn for your patience. The maturity is the date when the waiting ends. Those are the simple terms. Principal. Coupon maturity, 3 words. Most people can memorize them in a minute and still remain blind for 20 years. Because the real lesson is not in the vocabulary. The real lesson is in what these promises do once they begin trading through the system. I learned early that investing does not reward the man who collects definitions. It rewards the man who sees the chain reaction. The bond market is a chain reaction machine. The United States government collects enormous tax revenue, then spends more than it collects. That gap must be financed. So treasury bonds are issued. Investors buy them. Pension funds buy them. Insurance companies buy them. Banks buy them. Foreign governments buy them. Ordinary savers buy them indirectly through funds and retirement accounts. On the surface, this looks like a simple borrowing arrangement. Underneath, it is the starting gun for almost every other price in finance. People often imagine that money begins with banks. In reality, banks are downstream. They are not inventing the river. They are taking water from it, adding a spread, and selling it to you as if they created it. That is mechanism 1. I call it the benchmark machine, the government, because it is treated as one of the safest borrowers in the world, gives the financial system a baseline rate. The Treasury market says, in effect, this is what a very safe promise is worth right now. Once that number exists, everything else has to be priced against it. Mortgages, auto loans, corporate debt, private credit, commercial real estate, startup financing, the discount rate investors use to value future cash flows. The hurdle rate executives use when deciding whether to build a factory or cancel one. This is why I say the bond market prices time itself. If safe money suddenly pays much more, risky money must pay much more too. Nothing escapes that logic. Now let me make this practical. Because when an idea is true, you should be able to drag it out of the lecture hall and into a kitchen, an office, and a neighborhood. Imagine a family trying to buy a home. They walk into a bank thinking the bank is about to decide their fate. That is the illusion. The bank already had its fate whispered to it before the family arrived. The bond market moved first. When treasury yields are low, lenders can offer cheaper mortgages. Cheap mortgages expand affordability. Expanded affordability creates more buyers. More buyers chase a limited number of houses. Sellers get aggressive. Prices climb. Everybody thinks housing is strong because America is optimistic. Sometimes that is true, but a great deal of what people call optimism is simply the arithmetic of monthly payments. I have seen markets dressed up in emotional language when they were really just math in a costume. When yields rise, the costume changes. The same house can become impossible. Not because the kitchen got larger, not because the roof became better, not because the family suddenly became irresponsible, but because the price of waiting rose. The monthly payment swells. Buyers step back. The pool gets thinner. And yet even then, house prices do not always collapse the way textbooks suggest. Because existing owners are trapped by the low rates they already locked in, they do not want to give up a cheap mortgage for an expensive one. so inventory stays tight even while demand weakens. That is why modern markets often behave like bad theater. Fewer buyers, stubborn prices, frozen movement. Everybody waiting for someone else to blink. People blame greed, they blame banks, they blame politics, they blame immigrants, hedge funds, zoning boards, appraisers, and television. Some of those things matter around the edges. But the great hidden hand is still the bond market. It changed the monthly payment. That is enough to change the whole neighborhood. Now move from the house to the stock market. This is where many people get seduced into thinking bonds are the boring cousin and stocks are the glamorous one. I have made a lot of money in equities. I prefer productive businesses over sterile speculation. But I never make the mistake of believing stocks float free from interest rates. They never have. That brings me to mechanism 2. I call it the risk ladder. Every investor on earth is asking the same question, whether he admits it or not: how much extra return do I need in order to deserve the extra uncertainty? If a government bond offers very little, investors start reaching, they stretch, they move into stocks, they move into growth companies, they move into private markets, they move into anything that promises a little more air. That is not only because they become greedy, it is because the safe alternative offers so little that risk starts to feel rational. But when a government bond offers an attractive return, the whole ladder rearranges itself. A guaranteed yield begins competing with dreams, and dreams suddenly need to get a lot better. This is the part casual investors almost never internalize. When safe yields rise, stock valuations face a harder test. The future profits of a business are discounted more heavily. Investors demand a wider reward for taking uncertainty. Stocks no longer get to be expensive just because central banks made cash feel worthless. They have to earn their position. So a great many people look at a falling stock market and say, investors became fearful. Sometimes, but often the better explanation is simpler. The bond market offered them a serious alternative, a man deciding between a speculative asset and a government-backed yield is not always panicking. Sometimes he is just becoming less willing to pay fantasy prices. This is one reason long bull markets can create such dangerous habits. People begin to think stock prices rise because progress rises. They begin to think the multiple on earnings is a law of nature. They forget the water they were swimming in. Then yields move and everybody acts shocked that the same business is suddenly worth less, even though the store is still open and the customers are still buying. The store did not change. The discount rate changed. That single sentence explains more market history than most investors ever learn. Now let us take another step, because the consequences do not end with your brokerage account. They arrive at payroll. That is mechanism 3. I call it the refinancing trap. A huge number of companies do not grow solely from retained earnings. They borrow, they issue bonds, they refinance old debt with new debt. They expand into the future using money borrowed from the present. When rates are low, this feels intelligent, disciplined, even sophisticated. Executives speak about optimization, they speak about leverage efficiency, they speak about capital structure, analysts applaud, headcount grows, offices expand. Everybody feels modern, then rates reset. And the same brilliant structure becomes a choke collar. A company that borrowed cheaply in one era must eventually refinance in another. If government yields are much higher, corporate borrowing costs move higher too. If investors are nervous, the spread over government yields widens further. Suddenly the math is no longer theoretical. Interest expense jumps, projects are delayed, hiring freezes, layoffs, store closures, asset sales, research budgets cut, buybacks disappear, ambition shrinks. People who lose their job in that environment often think the company simply turned cruel. Sometimes management is cruel, but sometimes the company is just meeting a harsher price for money. I want you to notice how personal that becomes. A family cannot buy a home because yields rose. An investor loses half his paper gains because yields rose. An employee loses his job because yields rose. Same force, different costume. This is why I say the bond market is not finance trivia. It is the hidden metronome of modern life. If you do not understand it, you will keep mistaking symptoms for causes. Now, before we go further, I want to return to the bond itself, because a great many people know the words but still do not understand the seesaw. And until you understand the seesaw, you will keep misreading headlines. A bond has a fixed coupon. That part is simple, but once a bond is issued, it can trade in the secondary market. This is where old bonds meet new conditions. If newer bonds come out with more attractive rates, older bonds with lower coupons become less desirable unless their price falls. If newer bonds come out with lower rates, older bonds with higher coupons become more desirable, and their price rises. That is the seesaw: price up, yield down, price down, yield up. Simple enough to fit on a napkin, powerful enough to move trillions. The seesaw matters because markets are constantly repricing old promises against new reality. Nothing stays frozen. Yesterday's safe asset can become today's bad bargain, unless the price adjusts. That is a lesson far bigger than bonds. The market is always asking the same brutal question under current conditions. What is this promise really worth? The promise might be a treasury, it might be a business, it might be a house, it might even be a career path. The question does not change. Now, I want to give you another mechanism because people who truly build wealth do not merely understand assets. They understand transmission. Mechanism 4, I call it the sovereignty signal. When nations buy, hold, or sell bonds and reserves, they are not just moving numbers. They are expressing trust, fear, alignment, distance, dependence, ambition. Capital flows are political speech with arithmetic attached. If foreign buyers trust American debt, that supports the system. If they diversify away, that changes the cost structure of the future. If central banks alter reserve strategies, the signal extends beyond headlines about diplomacy. It enters borrowing conditions, currency stability, and long-duration asset prices. Most citizens never track any of this. They only feel the delayed consequence: mortgage offers, inflation pressure, pension performance, the availability of credit, the mood of employers, the tone of politicians. By the time the average family feels it, the signal has already been traveling for months or years. Money always moves in sequences. The public only notices the last link that leads to another dangerous mistake. People believe a central bank or a treasury department can simply announce the future into existence. They believe authority means control. Authority helps. It matters. But the bond market is a voting machine with real consequences. It can cooperate with policy, resist policy, or punish policy. A politician can make promises cheaply only while the financing system tolerates those promises. Once that tolerance changes, rhetoric becomes expensive. That is why large deficits are not just moral debates or ideological debates. They are financing debates. They are confidence debates. They are duration debates. They are questions about who will fund the gap, at what price, and for how long without demanding more compensation. You do not need a PhD to understand this. You need a willingness to stop staring at surfaces. Now let me give you the identity flip, because every worthwhile lesson eventually becomes personal. Most people think they are consumers of rates. They think rates are things that happen to them. They think the world is divided into experts who set the terms and ordinary people who endure them. That is the psychology of helplessness, and it is poison in finance. I want you to stop thinking like a victim of the price of money. I want you to think like an owner of the rules. You may not control the treasury market, neither do I. But you can control whether your life is built to survive different prices of money. You can control whether you are the person begging for capital at the worst possible moment, or the person sitting with liquidity when everybody else is cornered. You can control whether higher yields terrify you because they crush your weak balance sheet, or whether they create opportunities because you kept your balance sheet strong. That is the real flip. The amateur asks, what will rates do? The mature operator asks, what happens to me if I am wrong? That question has made me more money than prediction ever did. I do not build my life on elegant forecasts. I build it on resilience, optionality, and the refusal to become a forced seller. Bonds teach that lesson beautifully because they expose the penalty for pretending time is free. When money is cheap, foolish behavior can masquerade as genius. Over-leveraged companies look dynamic, weak real estate deals look workable, speculative portfolios look visionary, consumers feel richer than they are, governments feel more flexible than they are. Everybody acts as though tomorrow will finance yesterday forever. Then the price of time rises and the mask comes off. I have seen that movie many times. The names change, the costumes change, the decade changes, the principle does not. This is why I always tell people that you cannot judge a financial structure by how it behaves in a forgiving environment. You judge it by what happens when the current turns against it. A business funded by cheap debt is not truly strong just because it expanded quickly. A household is not truly secure just because it qualified for a payment during the easiest lending window in memory. A portfolio is not truly intelligent because it performed well when the discount rate was pinned to the floor. True strength is revealed when carrying costs rise, and bonds are the most direct expression of carrying cost that exists. Now let me show you the long chain more clearly. If government yields are low, mortgage rates usually become lower. Lower mortgage rates support higher home affordability that expands demand. Home prices rise. Consumers feel wealthier. Spending holds up. Business confidence improves. Investors move out the risk ladder because safe returns are thin. Stocks get higher valuations. Companies can borrow more cheaply. Hiring expands. Unprofitable projects survive longer. Private valuations inflate. The culture starts worshiping growth. Everybody grows accustomed to abundance. The whole machine begins acting as though capital is a public utility. Then yields rise. Mortgage affordability gets crushed. Home transactions slow. Housing mobility freezes. Equity valuations get squeezed because the safe alternative looks better and future earnings are discounted harder. Corporate refinancing gets painful. Layoffs spread. Zombie businesses lose oxygen. Speculative corners crack first, then respectable corners feel it later. Consumers who finance too much find they have no room. Governments face larger interest burdens. Political promises shrink or get financed more expensively. The mood darkens. Everybody suddenly wants discipline after spending years mocking discipline. That is not random. That is sequence. Money changes price, price changes behavior, behavior changes outcomes, outcomes change mood, mood changes politics, and politics then tries to explain what money already decided. If you see that chain, you are already ahead of most investors, most employees, and most voters. But seeing it is only the beginning. The real value comes from building a system around it. So let me tell you how I would think about it if I were starting again from scratch. First, I would stop treating cash flow as an afterthought. Most people obsess over asset values and neglect the monthly drain that determines whether they can stay in the game long enough to benefit from those assets. A rising rate world punishes people who own beautiful things with ugly financing. Second, I would separate productive debt from vanity debt. Debt that buys a strong productive asset at a disciplined price can be useful. Debt that exists to accelerate image, comfort, or speculation is usually a silent predator. The bond market eventually reminds you that every borrowed dollar has a landlord. Third, I would refuse to assume today's financing conditions are normal. They are merely current. That sounds trivial, but it changes behavior. If you understand that rates can move and stay moved, you buy fewer things that require a permanently generous world. Fourth, I would value duration properly. The longer the promise, the more sensitive it becomes to changes in rates. That is true in bonds. It is also true in businesses whose profits are far out in the future. It is true in real estate whose economics only work under soft financing. It is true in private assets marked by optimism rather than markets. Long-duration dreams suffer most when the price of time rises. Fifth, I would keep enough liquidity that I never have to sell quality under pressure. This is where many otherwise bright people fail. They are not wrong about the asset. They are wrong about the timeline. The bond market turns hostile, financing tightens, and suddenly they are selling the right thing at the wrong moment because they built their life too close to the edge. There is no wisdom in brilliance without endurance. The system I trust is not complicated. Own productive assets. Finance cautiously. Match your obligations to reality, not fantasy. Do not let short-term rates dictate long-term ruin. Maintain liquidity. And never forget that a world of cheap money can flatter bad judgment for far longer than you think. Now, let us go one layer deeper, because the bond market also forces you to rethink what safety means. Most people define safety emotionally. They say a house is safe because it is tangible, a stock is risky because it wiggles on a screen, cash is safe because the number does not move. None of those statements are complete. Safety is not only about volatility. Safety is about your need for the money, the price you paid, the financing attached, and the alternatives available. A government bond yielding very little may feel safe, but quietly guarantees a weak real return after inflation. A stock in a superb business bought at a disciplined price may look volatile yet prove safer over a decade than a bond locked at a poor yield. A house purchase with an oversized mortgage in an overheated market may feel secure because it has walls and a driveway, while in reality it is a leveraged bet on favorable financing and stable employment. Understanding bonds sharpens your judgment because it forces you to evaluate opportunity cost. Honestly, that phrase is overused, but here it matters. If safe bonds yield almost nothing, equities look more attractive. If safe bonds yield something meaningful, your required return from everything else should rise. If you ignore that, you start overpaying for risk. One of the costliest habits in markets is the habit of stale expectations. People anchored to the return environment that made them comfortable. If they grew up in a period where rates fell for decades, they assume valuation expansion is natural. If they built wealth in a period of abundant liquidity, they assume the future will forgive leverage. If they bought homes when mortgage rates were historically low, they assume real estate must always be rescued by affordability. They carry old assumptions into a new bond regime and call the pain surprising. It is not surprising. It is just new to them. I learned a long time ago that the world does not owe you continuity. That is why I admire simple models rooted in first principles. They travel better than stories. And the first principle here is mercilessly simple. The value of an asset is inseparable from the rate at which future cash flows are discounted and the cost at which it can be financed. That is bond logic. You can dress it up in different language. You can build spreadsheets around it. You can create television debates that avoid saying it plainly, but you cannot escape it. Now, I want to talk about ordinary workers because many financial discussions become sterile precisely where they ought to become human. A man working at a factory may not know the yield on the 10-year treasury. He may not know what a high yield spread is. He may never say the phrase refinancing risk in his life, and still the bond market may decide whether his overtime disappears, whether his company closes a line, whether his health benefits worsen, whether his town loses a major employer. This matters because ignorance does not create immunity. I do not say that to frighten people. I say it because understanding even the outline of the system gives you better instincts. If you know your industry depends heavily on borrowed money, you watch rates differently. If you know your employer has debt maturing soon, you pay attention to refinancing conditions. If you know your household budget is stretched, you stop assuming low monthly payments will always be available. You become less arrogant in booms and less confused in squeezes. That alone can improve your life. Knowledge does not guarantee wealth, but it reduces preventable stupidity. And preventable stupidity is one of the most common taxes in finance. Now let me turn this into a blueprint, because understanding without action is entertainment. Here is the protocol I would hand to any serious person who wants the bond market to work for him instead of against him. Start by asking what in your life is rate sensitive your mortgage aspirations are, your adjustable debt is, your employer may be, the valuation of your portfolio is. The timing of real estate purchases is the attractiveness of bonds versus stocks, is the viability of leveraged deals, is the sustainability of government promises, is map those dependencies, honestly. Then ask which of those dependencies are fragile, not emotional fragile. What breaks if financing remains expensive for years rather than months? What breaks if your income dips while carrying costs stay high? What breaks if your portfolio takes longer to recover because the discount rate has reset upward? Once you identify fragility, reduce it. Pay down the debt that turns you into a hostage. Lengthen the time horizon of your capital. Avoid businesses or personal purchases that only work under generous assumptions. Keep liquidity where it can defend you. And when safe yields are attractive, do not act insulted by the idea of earning a decent return without heroics. There are seasons when reaching for unnecessary risk is simply vanity in a tailored suit. I am an equity man by temperament because businesses compound. But temperament should never become dogma. There are times when government yields are high enough that they deserve respect. Not worship respect. They reset the menu. They make speculation compete harder. They offer patient investors a way to earn while waiting for better equity prices. They raise the standard for what counts as an opportunity. That is healthy. The culture tends to treat patience as laziness and caution as fear. I think that is backward in many periods. The highest form of intelligence is not action. It is disciplined refusal, refusal to overpay, refusal to overborrow, refusal to confuse momentum with safety, refusal to finance a fragile lifestyle on temporary conditions, refusal to believe that because money was nearly free yesterday, it should be nearly free tomorrow. The bond market teaches restraint better than any self-help book ever written. It teaches that promises have prices. It teaches that time is not free. It teaches that the future always sends a bill. That bill can arrive as a higher mortgage payment. It can arrive as a compressed stock multiple. It can arrive as a layoff notice. It can arrive as a government that suddenly discovers arithmetic. It can arrive as a refinancing cliff hidden inside a cheerful earnings call. However it arrives, the principle is the same. Somebody borrowed from tomorrow. Tomorrow answered. Now I want to end where I began because the lesson is not merely technical. It is moral. A society that misunderstands bonds, misunderstands consequences. It starts believing that comfort can be detached from cost, that deficits can be detached from funding, that valuations can be detached from rates, that jobs can be detached from financing, that leverage can be detached from danger. It begins treating money like mood instead of structure. That never lasts. Reality is patient. The bond market is one of reality's favorite instruments because it is difficult to flatter for long. You can manipulate sentiment for a while. You can subsidize illusions for a while. You can manufacture narratives, create acronyms, and celebrate paper gains. But eventually the price of lending, the demand for compensation, and the structure of obligations reassert themselves. That is why people who understand bonds often sound calmer in financial storms. They are not magicians. They simply recognize the weather sooner. They know that when yields move, the landscape will move. They know that when financing costs rise, weak structures will be exposed. They know that when safe returns become competitive, risk assets must earn their keep. They know that the man who needs the market to stay kind is in a far more dangerous position than the man who can endure unkindness. And that is the final test. Not whether you can define a bond, not whether you can recite principal, coupon, and maturity, not whether you can win an argument at dinner. The final test is whether your life, your investments, and your obligations are built to survive a higher price of money. Because if they are not, then you never understood money at all. You only understood the party. And the party is never the system. The system is what remains after the music stops. The debt rolls over, the refinancing bill arrives, the mortgage resets, the valuation compresses, the easy stories die, and only disciplined structure is left standing. That is where wealth survives. That is where freedom survives. That is where judgment proves itself. So when you hear the word bond, do not picture something dull. Picture the invisible hand on the thermostat of the whole economy. Picture the baseline from which mortgages are quoted, portfolios are repriced, payrolls are cut, and ambitions are financed. Picture the price of waiting. Picture the cost of trust. Picture the unseen river that banks draw from. Businesses kneel to, governments depend on, and investors ignore at their own expense. Then ask yourself one question, and answer it honestly. If the price of money stays higher than you hoped, does your life get stronger? Does it merely survive? Or does it start asking the future for mercy? Your answer to that question is worth more than 100 opinions about the next stock move, because in the end, money is not a story you tell yourself. It is a structure you either understand or pay for, and bonds are where that structure speaks most clearly.